They called it a war rally. But the numbers are telling a completely different story. Because during times of global conflict, precious metals are supposed to rise. That's the historical pattern investors have relied on for decades. When geopolitical tension increases, money moves into safe haven assets. Gold rises. Silver usually rises even faster. But right now, the market is doing the opposite. Just weeks ago, silver reached an extraordinary peak of $121 per ounce, the highest level in its modern trading history. Today, the metal is trading near $67. That's a collapse of nearly 45% from the peak. And according to some analysts, the next move could be even more surprising. Several projections now suggest silver could briefly fall toward $50 per ounce before the next major move begins. So the question is obvious. Why is silver falling during one of the most unstable geopolitical periods in recent years? And more importantly, what does the market know that most investors still don't? This is John A.G. Reports, where we decode the financial system instead of chasing the headlines. And today, we're breaking down the hidden forces behind one of the strangest moves in the precious metals market. Let's start with the timeline. 12 months ago, silver was trading around $34 per ounce. At that time, the metal had spent years stuck in a frustrating sideways range. Most investors had already lost patience with the market, but then something changed. Demand began to accelerate. Institutional capital started moving back into precious metals. And suddenly, silver entered one of the most aggressive rallies the market had seen in decades. Within months, the price surged dramatically, eventually reaching $121 per ounce. For long-term investors, it looked like the beginning of a historic breakout. Some analysts even started talking about a new silver supercycle. But financial markets rarely reward consensus for long. And when the rally peaked, the reversal came quickly. Silver fell sharply, wiping out a large portion of its gains in a matter of weeks. Today, the metal sits near $67. But to understand why this happened, we have to look beyond the silver market itself. Because the first domino actually fell in the energy market. As geopolitical tensions escalated across key regions of the Middle East, oil prices surged almost immediately. Energy markets react extremely fast to instability in that region. And when oil rises, inflation fears usually follow. That's exactly what happened. As oil prices climbed, inflation concerns returned to the center of the financial conversation. And that created a major problem for central banks. Because when inflation is rising, cutting interest rates becomes much harder. This is where the Federal Reserve changed the story. Instead of promising aggressive rate cuts, the Fed signaled that interest rates may remain higher for longer. That single shift had massive consequences across global markets. Bond yields moved higher. Capital flowed back into the United States. And the US dollar strengthened significantly. That's a critical point for precious metals, because gold and silver are priced in dollars. When the dollar becomes stronger, metals become more expensive for international buyers. Demand slows, and prices come under pressure. But that's only the surface explanation, because while the paper price of silver has been falling, something very unusual has been happening in the physical silver market. Inside the COMEX exchange, which handles the largest silver futures market in the world, inventories have been shrinking dramatically. Registered silver, the metal actually available for delivery, has fallen to around 95 million ounces. That might sound large, but historically it's extremely tight. In fact, registered COMEX silver has declined by nearly 67% from previous levels, which means the physical cushion backing the futures market is getting thinner. And that creates a contradiction. The paper market suggests weakness, but the physical market suggests tightening supply. And when those two signals start moving in opposite directions, markets can become unstable, because eventually one of them has to adjust. Either supply increases, or the price moves higher to reflect scarcity. At the same time, another major shift has been happening behind the scenes. Institutional investors have been pulling money out of silver funds. Over the past months, silver ETFs have experienced roughly $6 billion in outflows. Large capital leaving the market can create strong downward pressure in the short term. But it also raises an important question. Are institutions abandoning silver, or are they repositioning ahead of the next phase of the market? Because if history has taught investors anything about silver, it's this. When the metal moves, it rarely moves slowly. And the long-term fundamentals behind silver demand remain extremely powerful. Unlike gold, silver is not only a monetary metal. It is also a critical industrial resource. Solar panels require silver. Electric vehicles depend on it. Advanced electronics, semiconductors, and energy infrastructure all use silver as a key material. As the global economy shifts toward electrification and renewable energy, demand for silver continues to expand, but supply growth is extremely limited. Mining projects take many years to develop. Production cannot suddenly double when prices rise, which means the silver market now sits at a very unusual intersection. Short-term macro forces, like a strong dollar and high interest rates, are pushing prices lower, but long-term structural demand is quietly building underneath the surface. If those two forces collide, the next move could be extremely powerful. That's why some analysts are watching the possibility of a short-term drop toward $50 before the next major cycle begins, because markets often shake out weak hands before the real move starts. So now the focus shifts to three critical signals investors should watch closely: the direction of the US dollar, future decisions from the Federal Reserve, and the physical silver inventory levels inside COMEX vaults, because when those signals begin to align, the silver market can change direction very quickly. And when it does, the opportunity, or the risk, usually arrives before most investors are ready. This is John A.G. Reports. And in financial markets, the most important signals are often hidden in the data that almost nobody is paying attention to.